start off with the options that are available to investors. There are other asset classes that are out there, but they each have their strengths and weaknesses, and I want to take a good faith sort of examination of all of these. So I'm a typical sophisticated investor. I got a few $1 million to invest. I come and see you, and I'm expecting to hear about property, fixed interest, equities. What do you tell me about each of those?
If I had my way, I'd just talk about Bitcoin for the entire time, but unfortunately that is not possible at this point in time. But if we scan the investment universe, obviously it's stocks, properties, bonds, commodities is basically where everything falls into. And in thinking about Bitcoin as an asset class, I think it's critical to think about the opportunity cost of putting money into Bitcoin as opposed to those other assets and where we are right now. So when we set up from a macro perspective, I think there's been a paradigm shift in the last 18 months with the interest rates. We've seen, effectively, interest rates have been a tailwind for all asset classes for the last 40 years, and we've seen that tailwind change in the last 12 months. So all of a sudden now that conversation that we'd have around property shares and bonds is now a much more complicated discussion, and it's a far more difficult asset class to invest in across the board. And this is where it sort of brings me to Bitcoin having a far higher weighting and allocation to clients' portfolios, because now we are effectively at a 40-year turn. We now need to think a lot more critically around how we're going to de-risk effectively a portfolio. We need to look very differently at the types of shares, the types of properties, and even the commodities that we're looking at. Not that we play in the commodity space, and on a personal note, and probably it's a soft touch in with this audience, but we haven't invested in bonds for a very long time because we think there is an inherent risk in those markets. So.
But wait. Bonds are risk-free. I learnt this. They are the safest form. In fact, the old saying is risk equals return. In other words, if you want a really high return, you've got to take some higher risk. And that's going to be appealing for some people. For a lot, it's not. So I'm going to go ultra low risk. I'm going to go bonds.
What's that truth in advertising? That they advertise as something and they're completely different. And this is where there's a common misconception with bonds. Typically, most people think, oh, bonds are secure, we can have that, and it's money good. We're not going to have any problems. And this sort of brings us to quite a topical thing that we've seen in the US in the last month with their banks, and particularly their crypto banks, falling over or having huge difficulties with liquidity. Or it's not so much, it's liquidity, but it's also now solvency. And the difference between liquidity and solvency from a banking perspective is liquidity is being able to meet the payments on a day-to-day basis, and solvency is the issue of actually being able to run the bank ongoing. And so the ironic thing about this is that, the bonds that were invested in these, for these banks invested in bonds, they thought they were money good. It was risk-free. They even had an accounting quirk that enabled them to leave that on the books at par value that they bought it for, despite the fact that if they had to sell that on the market tomorrow, it would be at least 20% below what they bought it for. And lo and behold, they had to sell enough assets that they got to the ones that they were holding for a long term that they needed to meet. So all of a sudden there's a huge hole on the balance sheet of nearly 20%. And the sad thing is that the crypto banks got, pummeled with this, but this wasn't just a crypto bank problem, this was a nationwide problem with all the banks. Yeah. So this is where when we think about Bitcoin as an asset class, we've got to assess the full risks of the investments that we're doing. And when you're looking at a banking system that is effectively insolvent, all of a sudden all bets are off. You need to think really creatively about where you need to put money, because for the last 25 years I've been in and around finance effectively in both sides of the balance sheet. For the first time in history, you need to actually think about where you're putting the money, because you're not going to know, you don't know with confidence that they're going to be around in the next 12 months. And this is where I think there's a very small window of opportunity that's actually getting much larger for clients to then go down a journey of, here's what I call the risk-free asset being Bitcoin.
Oh man, there's so much to say. So the first one is the bonds that we are speaking about here in this context aren't issued by a failing sub-Saharan sort of nation state here. This is we saw the same in the gilt market in the UK, right? US Treasury, sort of like the gold class of these bonds, and these are instruments where people lost 30, 40% in the case of a year. So it's definitely worth, I think, digging into the risks a little bit here. I'm going to play devil's advocate a little bit. Now, because in the case of US Treasuries, they will always be made whole, right? Because even if there isn't the money available to settle the bond and to make the coupon payments, I can just create more money, right? So what's the risk then? Okay, short-term risk, I buy it on the primary market, it'll trade on the secondary market. Those prices can go up or down. But the lament that I've heard from certain other mates in TradFi is, yeah, but if you hold to maturity, I am guaranteed to get it back. The only sort of risk is that the government no longer exists anymore, and that's probably a small risk for some of the sovereigns that we're talking about.
There is an opportunity cost, and this is what I think a lot of people fail to really understand. And this is where I think this room understands opportunity cost better than any other room in finance, because when you start pricing things in Bitcoin and you look at holding that for maybe a 5 or a 10-year period, you start to realise the opportunity cost of having or holding dollars v something else. And now back to the bonds, you might be made money good on what you put in, but the opportunity cost of having a lower interest rate for a longer period of time means that you have to hold that till maturity to get your money. Yeah. And then that to me is the biggest cost of that. And then...
By the way, can you imagine lending someone money for 30 years at 1%?
No, I would not be making that deal.
Happened a lot. Just let that sink in. And of course, inflation, right? I mean, this is the thing that the world has rediscovered in the last 18 months. I think in Australia it's unique, right? We've got people sort of our vintage here. We've been through our entire careers and we've never had a recession. We've never had any kind of problems with inflation. Interest rates have pretty much only gone in sort of one direction. And so you've got people mid-career, towards the end of their career, now sort of realising that this is a bit of a problem. Did you see the thing the other day? It was in the AFR. They had, I think it was the IMF, had some forecasts for Australia's inflation. Don't worry, it's going to get back to normal in 2025 or something like that. It was only 7%, and then it was only 6%, and then it was back to 3%. Now do the maths on that. And that means if you're going to be super conservative, Harry, and pop your money under the mattress, you've actually lost about 15% of your purchasing power just in cash. Now think about that maths and call the interest rate 2% just to be super ultra generous, and then multiply that for 30 years. You're going to get made whole. You will be made money whole. The government will pay you back your money. Will you be able to buy the same amount of stuff with that money? And I think for me, that's the risk that I think so much of us kind of miss.
And that's what I've dealt with on a personal front. You go shopping and, they're telling us something, and when I go to the shops and I do a shop for a week or whatever we're doing, whether it's meat, whether it's fruit and veggies, you name it, prices have gone up dramatically. And I would have thought closer to 50%, yet they're telling me, oh no, inflation's peaked out at 9%.
You just got to look at core inflation, Pete. So just strip out fuel and food, shelter, those annoying things. Yeah. It's actually not that bad.
Well, I know we're going to get to this in just a minute, but, I'm not living under a bridge, so sadly, yet, I do need to pay for those things.
Yes. So. So let's talk a bit about, so our game, diversification, right? The diversification is one of those, I've always preached it as it's one of the very few free kicks you get in investing, in the sense that it is guaranteed to reduce your overall risk. And the great analogy here is just don't put all your eggs in one basket. And I know with a lot of, you've told me before, a lot of the clients that you see, you're not going to throw them straight into the deep end. They're going to want a bit of diversification. And then you raise this thing called Bitcoin. They go, okay, I'm curious. I'm Bitcoin curious. But I want some diversification in there. So I don't know if Bitcoin's going to win. So maybe it's just prudent financial management. I'm going to put some in Bitcoin because you make a pretty good case. But maybe I should have a little bit in Ripple. Maybe I should have a little bit in this, just because that is smart. That is diversification.
I might just go back to...
This is devil's advocate before anyone storms the stage and rips me. pieces.
I think diversification, we've been sold that as a way to increase the volume of funds that flow into index funds. And I think if you go back to Warren Buffett's early days, Charlie Munger, they weren't diversifying. They were putting 100% of their assets into the best investment that they could find. And this is where...
Was it diversification, the term that they used?
It's a great one. And this is where we have an opportunity with this asset that not a lot of people understand. You know, there's 300 people sitting in a room on a Saturday wanting to learn more about this asset, yet all of a sudden there's 4 million people in Sydney who do not care about this. And kudos to everyone in the room today that we are miles in front of everyone else when it comes to this. And this is where, you know, the diversification will have thought of that when it comes to asset classes. In the broad sense of finance, yes, completely understand that. But if you look at, you know, the idols in the fiat world, it's Warren Buffett, Charlie Munger. They don't subscribe to that. They've just gotten so big that they can't invest all their spare cash into a single asset. They've got to diversify it. So, ironically, they could put all of their money into Bitcoin.
Yeah. It ain't going to happen.
Sadly not.
Uncle Warren was in the press the other day talking about it being what was it, a gambling chip or something. I was just saying to Peter off stage that the real irony here is that these guys, who I've got a lot of respect for, I've got to say, they've done some good things, but they need to listen to their own advice. One thing that Charlie Munger says a lot is take a wild idea and take it seriously. It's like, well, Charlie, look in the mirror. The second point I think that he makes is you need to be able to explain the bear case better than the bears. So I like Amazon stock, for example. Great, I've got a big position, but it's just prudent investing to understand the other side of the trade. You've got to be able to shoot it down, or at least understand where the angle is. And it feels like another thing maybe that's some good advice, Charlie, that you might want to take on board.
So on that, what is the bear case for Bitcoin?
So the bear case so my journey very quickly was I was very anti-crypto and Bitcoin for a long time, and just didn't die. So I thought I need to finally put a nail in this thing and get on with my life. And I haven't actually found a good bear case, except for I think the one is the Rumsfeld unknown unknowns. And this is just being, I think, purely intellectually honest here. Is that the system, the protocol could collapse. It might not be here. The more you go down the rabbit hole, the more you realize that that's a very unlikely proposition. Again, I'm getting a lot of dirty looks up here. But it could happen. It could absolutely happen. But that's kind of the last one that's left standing. And I think one of the ways I've always thought about it is one of the bits of maths that's very handy for investors is called the expected value calculation. And it's just a way of sort of framing up what are the odds like for an investment. It's hard to sort of do verbally, but I just take the odds of an event and I multiply that by the outcome of that event and I put it all together. So very simply, I think it's realistic and sensible to sort of say with Bitcoin, it could be zero. Now, I think when you first start off, you probably think maybe that's a 50-50 chance. As you go further down, you realize that's diminishingly smaller. But let's say that it is a 50-50 chance and it goes to zero. And I think if it doesn't go to zero, in other words, if the system doesn't collapse and the adoption, that J-curve that Ben was talking about before continues, it's worth a lot. And I really want to get your valuation on it too before we run out of time. And we can argue and everyone will have sort of some kind of price target, but it's a lot, right? Even if this thing just replaces gold, it's a 20x from here. And so you've got a situation where okay, heads, I lose it all. Tails, 20x. And I think as Pete will outline, probably a heck of a lot more than 20x. You do the maths on that, and it's a positive value. And that says to you that you should probably have a little bit of money in this. And I would also argue, and sort of the point I make with my TradFi friends is, just get off zero, right? Get 3%. 4%, 5%. That's a daily fluctuation on the stock market. I mean, you are not going to lose any sleep over that, or if you are, you're in the wrong game. And we can all have a good laugh in 10 years' time over a beer about that stupid Bitcoin craze. Do you remember that in the 2020s, how everyone got into Bitcoin? What a dumb idea that was. But if not, the upside this is literally the most asymmetric bet in history. Is it a guarantee? No, nothing's a guarantee. But if it's right, if it's right, it's not like this thing gets to 100 grand per coin, right? Or $1 million per coin. And it's sort of like, why would you not take that when the expected value calculation is so extreme? And again, go home, Google it, do the maths, plug the numbers in that are right to you. And I think, Pete, this is one of the other things we wanted to touch on is for those that are looking at sort of managing their capital, how do you approach it from a weighting point of view within, okay, we're not going to diversify within crypto, but within Bitcoin, where do I start? 5, 10, 20?
I personally would like to start with a 5 to 10% weighting, but that is very unpalatable for a lot of people. And you need to meet people where they are. Yeah. And this is where, I think it's a reasonable assumption to, talk about a 1% allocation, to your point, which I think is a really valid point and important for clients to comprehend the daily value or the daily fluctuations. When you put it in those terms, it's literally a bad day in the market. Yeah. Now, what I think is sort of sticks a lot longer than the daily fluctuations is the thought of being wrong from an ego perspective. Why did I do that? That was stupid. And that comes down to, I think, probably a lesson that we're all given as children, that when it comes to finances, if something is too good to be true, it probably is. And so when you start doing the work on Bitcoin and you talk about valuation of $1 million and a 30x from here, and it's basically risk-free, and all of a sudden there are multiple red flags that are basically pinging in people's heads that, hang on, this is a rort, this is a scam, this is too good to be true, it can't be.
Surely it's not that,
It's not that easy.
Yeah.
And as probably we all understand or know here, that Bitcoin is not that easy. There are these gains in front of us, I believe. There's been the gains in the past, but the real difficulty is getting from A to B and holding it and keeping your sanity with the volatility of Bitcoin. Yeah. And therein lies the crutch.
There's some great, I use this all the time, but there's some great parallels with equity investing. And you can go back, do the exercise for yourself, but just go and pick the best performing stock you can find over the last 10 or 20 years. Amazon's a good example, or Apple. People tend to go with these kinds of things. The truth is that despite the insane value creation that's happened there, the number of times those things drop 20 or 30% throughout that journey, all the time. And these are the best stocks, right? So this is par for the course. This is the ticket to the dance. And I think that's a very good mental model to bring with you to Bitcoin. I'm pretty bullish, but I'll bet my left arm that all of us suffer multiple 50% drawdowns over our careers. Like, we're probably going to, and if not, at least we should be prepared for that kind of thing. But volatility is not risk, right? That's the other thing that Buffett likes to talk about. Risk is the loss of is the chance of permanent loss of capital here. It's not volatility. In fact, the other thing people talk about with Bitcoin is, despite the volatility, despite a horror year last year, it is over any 4-year period the best performing asset class. Not like it's outperformed bonds by 3% or equities, like by a lot, which I think is really interesting. And the other point I wanted to make before the time runs out, where I think there's a contrast here with traditional type of investing, is that there is a relationship between price and return, in the sense that the higher a price in a stock goes, the lower the future return. It makes sense. This company has X amount of discount or cash flow ahead of it. We can discount that back and we can work out an intrinsic value, a fair value. Now, my goal as an investor is to find what that value is and then buy. I want to buy dollar notes. Get this right. I want to buy a Bitcoin for 50 million Satoshis, right? That's the trade. That's what you're trying to do. The reverse is true as well. The more you can, Charlie Munger again, you can buy the best company in the world and lose your shirt if you overpay for it, right? Apple, again, a great company. Is it worth $10 trillion a share? No, clearly it's not. The thing that's weird about Bitcoin is that it's something, and you taught me this term because I'd never heard of it before. I had to write it down. It is a Veblen good. Anyone heard of a Veblen good before? Okay, I'm not alone. That makes me feel better. But the concept is simple. It is where the price of something goes up, it becomes more valuable. It's very counterintuitive. And what does that mean? So imagine that Bitcoin is only $1 a coin. So the market cap, the total value of the protocol is $21 million. that is absolutely useless unless you want to do some drug deals on the dark web. You know, that's about all it's going to be good for. If you get to something where we are at the moment, where we've got, what is it, $600 billion US market cap, you can now have institutions, you can have sovereign states putting money on it. We can settle international global trades, these kinds of things. It's more valuable. Let's say we fast forward this and let's say you get to $100,000 a coin. And now you've got a system here where you've got a pool of liquidity and depth that it becomes very, very feasible for me to do extremely large transactions without just ruining the market. And this is what happens with very small micro-cap stocks, for example. They might be the best company in the world, but there might be $3,000 worth of shares traded a day. Charlie and Warren's problem again. They can't buy it because the liquidity isn't there. And so this is, I think, a very important concept for investors to understand. My wife was saying to me the other day, it's like, when do we sell? It's like, well, the hard thing is that the more it goes up, the more my conviction will grow and the more its use case grows. And that, so I actually don't know if we ever will sell because it becomes more and more potent at that. Is there anything you'd add to that?
And I think this is the problem with traditional finance in understanding those paradoxes that Bitcoin presents. Yeah. You know, we've talked about a couple of them, that the more it goes up, the more it goes up. We've talked about the fact that we're talking about diversification. And it's like, these are all traditional concepts in, you know, finance that have stood the test of time, that have basically saved families, saved nations, saved states. And, you know, this has been time-honoured wisdom that's been passed down. And then you have this little thing called Bitcoin, which turns all that on its head and throws out all that wisdom. And this is the counterintuitive thing with Bitcoin that requires so much work to get that conviction and understanding that there's nothing after Bitcoin. It's not, there's no new Bitcoin, which we all love hearing about in crypto space. It's Bitcoin and that's it.
And that's all there is. We could go on, but
I'd like to.
But the hook is going to come out of stage left any moment now. So, mate, thanks for the chat. Thanks, everyone.